there are reports that China's most valuable firm, Alibaba, plans to raise as much as $20 billion through a second listing in Hong Kong. Now, this could potentially be the biggest global follow-on share sale in 7 years. The deal would also give Alibaba a war chest to keep investing in technology. Right now, that's a priority for China as growth flags and as it continues its trade spat with the United States. In 2014, Alibaba's IPO in New York raised $25 billion, and at the time, Hong Kong authorities had turned down Alibaba's application to list because of its management structure, but rules, they were eased last year to allow dual-class share listings. Alibaba has so far declined to comment. Its largest investor, SoftBank Group, well, they're also keeping mum. Bloomberg, meanwhile, reports that the firm is in talks with financial advisors and it could file an application as early as the second half of this year. A Hong Kong listing would also help Alibaba boost liquidity and get a potentially better valuation if it becomes a favorite among retail investors. Roland Lim with more.
Now, Alibaba hasn't commented on the report yet, but it is reportedly working with financial advisors on a planned offering aiming to file a listing application as early as the second half of this year. It's all at the preliminary stage, and the second listing is a chance, really, for Alibaba to diversify its funding channels as well as to boost liquidity. Will it be second time lucky for Hong Kong? Well, remember, the city missed out big time when it wasn't ready in 2014. Hong Kong Stock Exchange had to reject Alibaba's application because the company wanted to adopt a dual-class share structure. Now, Alibaba eventually listed in New York, raising a record $25 billion US. Hong Kong finally did give the green light to allow dual-class share listings last year, and specifically targeting new economy as well as tech companies. And that's given a shot in the arm for the HKX. Chinese companies like food delivery giant Meituan Dianping, as well as smartphone maker Xiaomi, successfully listed shares with different voting rights here already. However, the listing environment has changed somewhat. Chinese companies are now facing an increasingly hostile U.S. government. Several Chinese tech companies also have been put on a U.S. blacklist. Earlier, we've also seen Chinese games streaming giant, I should say, Douyu, postponing its IPO launch over market jitters about the trade war. Hong Kong still holds the IPO crown last year, but may be overtaken by the US this year. New York has been more successful in wooing over new economy companies. It also doesn't bode well for the local tech darlings. Xiaomi, as I mentioned earlier, lost some 37% since its debut in July, while a food delivery company, Meituan, down 16% from its IPO price in September. So it remains to be seen if the market will have an appetite for such a mega IPO.